Level 1. Structuring. Carrying around $18,000 in cash, you quickly run into the most absurd banking rule. Never try to deposit more than $9,900 into your checking account all at once. Financial institutions are required to file a report for any cash deposit of $10,000 or more. This process is fully automated and doesn't require any prior suspicion from bank employees. By splitting $18,000 into two parts, you make deposits at two separate bank branches. This process is called structuring, and on its own, it's considered a serious federal crime in the U.S. The violation comes from intentionally evading reporting requirements, regardless of where the money came from. The main problem is that banks constantly monitor any suspicious repeating transactions. Bankers will immediately file a suspicious activity report if they notice an attempt to avoid scrutiny. Modern computer systems at financial institutions automatically flag these deposit-splitting schemes. Level 2. Cash-intensive businesses. Buying an ordinary laundromat is a great move because it's a popular cash-intensive business in America. The core idea is to mix dirty money with the legitimate profits of your business. Making $4,000 legitimately, you declare $6,000, adding $2,000 in illegal cash as revenue. Paying taxes on phantom income allows you to quickly make the money completely legal. Tax inspectors find it extremely difficult to disprove a business's actual daily cash receipts. Car washes, beauty salons, and vending machines are also perfect for these kinds of financial operations. The main limitation of this method is the maximum realistic profit margin of a specific small establishment. Investigators typically check the actual water, electricity, and detergent consumption of the chosen business. A major discrepancy between purchased resources and declared income will immediately trigger a serious audit. A tax audit in this scenario can quickly turn into a full-scale criminal investigation. Level 3. Shell companies and phantom invoices. When the laundromat hits its ceiling, you create shell companies that exist only on paper. These entities use basic P.O. boxes instead of actual physical offices. A shell company sends your business phantom invoices for non-existent marketing services. Your company pays these invoices, successfully transferring funds to another entity's account. In money laundering terminology, this layering process effectively conceals the origin of the funds. A single fake invoice looks like a routine expense, but 20 of them will raise red flags. Bringing in experienced lawyers and accountants becomes a critical element in building such a network. Investigators usually look for shared registered agents and identical legal addresses across multiple companies. Multiple firms using a single P.O. box quickly exposes the structure of the entire criminal network. It's precisely these connections between legal entities that form the foundation for a solid criminal case. Level 4. Real estate. The real estate market attracts criminals due to the subjective valuation of residential and commercial properties. You buy an old house for $200,000 using cash and a standard mortgage. A year later, you sell the property to your own shell company for $500,000. The $300,000 difference becomes clean profit from a completely legal real estate deal. Cash purchases historically faced far less scrutiny compared to bank-financed transactions. Many countries are starting to require the disclosure of the actual beneficial owners behind these companies. This method allows you to clean millions of dollars by pulling off a few large deals in a row. Real estate agents often have far fewer financial reporting obligations than banks do. Regulators are actively trying to close this loophole by expanding requirements for real estate professionals. Unwittingly, realtors and title companies help transfer massive amounts of illegal cash. Level 5. Offshore structures. Domestic laundering methods quickly hit a ceiling due to information sharing between government agencies. The offshore approach relies on jurisdictions with minimal owner disclosure requirements. Money flows into the account of an offshore company owned by a trust managed by a nominee agent. Transfers are routed through several countries, making it significantly harder to trace the ultimate beneficiary. Some countries cooperate easily, but others require years of complex international legal procedures. The automatic exchange of tax information has put heavy pressure on popular offshore jurisdictions recently. Still, this method remains effective thanks to the ability to set up companies in new regions. Massive document leaks revealed the inner workings of leading offshore law firms worldwide. Thousands of shell companies used identical document templates to run various financial transactions. These leaks handed investigators complete client lists, speeding up investigations into international crimes. Level 6. Trade-based money laundering. Trade-based laundering is considered the hardest to detect because it hides inside ordinary international commerce. The technique relies on over-invoicing or under-invoicing goods that constantly cross international borders. Your company ships a container of furniture, sending an invoice for an amount way higher than its actual value. The buyer pays the inflated invoice, transferring dirty cash under the guise of a legitimate payment for goods. Customs authorities are focused on stopping contraband, not on verifying the true value of furniture. Investigators estimate trade-based laundering at billions of dollars globally every single year. Detecting this method requires complex cross-matching of customs declarations and invoices across multiple countries. Trade data analytics help identify prices that stray significantly outside normal market ranges. Systematic price deviations over extended periods attract the attention of specialized customs control units. Isolated cases rarely raise suspicion, but long-term abnormal trends always catch investigators' eyes. Level 7. Crypto mixing. Using cryptocurrency mixers makes it possible to hide the direct link between sender and final recipient. These services blend crypto from multiple users, sending an equivalent amount to a brand new wallet address. The public blockchain permanently stores every transaction, allowing specialized analytical tools to follow the money. Investigators analyze time intervals and transfer volumes to uncover connections inside crypto mixers. Law enforcement agencies have repeatedly taken down major mixers, seizing servers and complete transaction logs. Promised anonymity often turns out to be temporary, vanishing the moment law enforcement seizes the equipment. Criminals also exploit the varying identity verification requirements between different crypto exchanges. Funds are moved from regulated exchanges to platforms lacking proper financial controls and checks. Analytics firms have built successful businesses mapping these complex transfers between wallets. They recreate flowcharts similar to shell company networks in the traditional financial system. Level 8. Correspondent banking accounts. At the highest level, individual transactions lose meaning because laundering happens inside the banking system itself. Correspondent accounts allow banks to conduct international transfers on behalf of their foreign partners. Criminals exploit institutions that turn a blind eye to suspicious activity or lack properly trained staff. These schemes come to light thanks to internal whistleblowers or routine audits by financial regulators. Major banking institutions have faced massive fines for systemic failures in tracking suspicious cash flows. The root cause is rarely direct collusion, but rather a weak compliance culture within the institution. Compliance departments are often overwhelmed by thousands of daily alerts and lack the necessary resources. Employee bonus systems reward transaction volume rather than the thorough vetting of questionable activity. Lucrative correspondent relationships are seldom subjected to strict analysis until external pressure mounts. Major scandals look like a slow systemic failure of a bank to ask simple and obvious questions. Level 9. Insiders and whistleblowers. Behind every successful investigation, there's usually a real person rather than just a paper trail. Accountants, disgruntled employees, or corporate agents often decide to hand crucial documents over to law enforcement. Whistleblower protection programs in the U.S. offer substantial financial rewards for providing valuable information. Internal cooperation makes it possible to dismantle complex networks hidden from standard external investigation. Someone who saw the shell company network from the inside holds unique and critical intelligence. No official requests can replicate the insider information provided by a direct participant. All of these methods can withstand external government financial analysis for years. Yet almost no scheme survives a motivated insider's decision to reveal the truth to law enforcement. Witness testimony becomes the decisive factor in court when prosecuting complex financial crimes. The human element remains the weakest link in even the most sophisticated money laundering system. Level 10. How it all collapses. Every level of this system eventually comes down to one requirement: explaining where the money came from. U.S. financial intelligence, known as FinCEN, collects suspicious activity reports from around the globe. A single fake invoice seems routine, but combined with others, it exposes an entire criminal infrastructure. It takes investigators years to gather evidence and tie all the pieces into a single criminal case. Criminals are undone by the slow accumulation of transaction data across every level of the system. Evidence falls into a straight line, connecting the original source of funds directly to the final recipient. These investigations require massive resources, international requests, and deep forensic analysis of countless documents. Each new level is built to make it as hard as possible for investigators to trace the money. In the end, the system falls apart due to a lack of time, depleted law enforcement resources, or expiring statutes of limitations. Let me know in the comments what topic you'd like us to break down in equal detail next.